Hello, welcome everyone. Welcome to today's class. So earlier we were doing responsibility centers and we did cost center, revenue center, and we were almost towards the end of the profit center. And today we are going to do investment center. Let me just revise what we did earlier so that you guys. So what is a cost center manager responsible for? And what's a profit center manager responsible for? In a divisionalized structure, okay, your company can be divided into centers, right? And each center will have their own responsibility. Okay, so based upon the responsibility, we can divide on the basis of cost center, revenue centers. There can be revenue centers who are just responsible for the revenues, and then there could be profit centers, and then investment center. So talking about their responsibilities, so I told you about the controllability principle. First of all, what a person should be responsible for, okay, he'll be given some certain target. And then definitely on the basis of whether he has performed well or not, you're going to do the performance assessment. So what is the responsibility? Sure, you will appraise its performance on the basis of the controllable factors only. What he could control, okay, would only be traced to his division. Okay, all the controllable revenues and the controllable cost would be traced to a profit center manager. Okay, what he could not control or what he could not influence, definitely you won't be making him accountable for that. So first of all comes the responsibility, what the person can control, and then definitely starts the accountability. So and then you try to assess the performance of a particular manager, okay, taking into account what was he responsible for, whether he was responsible for cost. In a cost center manager, the entire responsibility for a manager is that of the cost. He is not concerned with generating revenues, and a revenue center manager has got nothing to do with the cost, whether a cost may be incurred in definitely generation of sales, but he won't be charged for that. He is only responsible for the uh, generation of revenue only. Sales, that's what is his responsibility. So his responsibility was revenue only. Cost center manager responsibility is cost only. And profit, how do you measure profit? Okay, yesterday we were doing it. Sales less cost, what you get is profit. The three ways profit can be measured. So whatever would be a controllable revenue for that manager, what he could control would ultimately be traced with his division, and then he would be accounted for that. And whatever cost he would control, that would be traced to his division, and then ultimately a profit would be calculated, and then his performance can be assessed whether he has attained that target or not. Okay, so profit center manager performance targets could be based upon, we talked about gross profit margin, it could be net operating profit margin, it could be net profit margin, and we talked about what is a gross profit, what is an operating profit, and what is a net profit. Okay, so talking again, sales less production cost. What is your sales is basically not what you will earn as in profit in the end. Okay, so keeping the shareholder, your investors in mind, you definitely, why you're doing an operation at the first place, because you need to maximize shareholder wealth. You need to, and how shareholder wealth can be maximized by maximizing the revenue, by minimizing the cost, by increasing the market share, improving quality. So all that, by increasing the profit. So all that needs to be done. Okay, that's why we are hiring people, and definitely we are setting their targets and making them accountable for a certain thing, and then in the end assessing their performance, whether they've achieved their objectives or not, and that too on the basis of the factor they could control, which is basically the controllability principle. Okay, so sales, for example, and we took an example, for example, 1 lakh is the sale and production cost is 50,000. So what would be the gross profit here? So gross profit here would be 50,000. Now how gross profit margin would be calculated? He will be given certain gross profit margin. For example, the targeted gross profit margin for that manager was 30%. And what he attained here, gross profit divided by sales, if 100% is what he has received, but in the end he has incurred 50% of the cost as well. So what is he earning? The gross profit is basically 50%. And what else need to be deducted? We only deducted production costs at the moment. Definitely we will market the product, we will distribute the product into the market. Definitely we'll be incurring some admin cost as well. So non-production costs need to be deducted as well. So what you received was 100%, but that's not something you get in the end. Here you only got 50 because you incurred cost in the production, material, labor, expense, okay, direct, indirect cost, prime cost, and overhead you've incurred in converting the material into finished good as well. So that was your cost. So what you got as your gross profit to be 50%. And now, for example, you will deduct your non-production cost as well. So we talked about the non-production cost was, for example, 10,000. So what is your operating profit? Operating profit is the profit you get from your direct operations, from your main operations. So an operating profit, I told you, is also known as profit before interest and tax. Okay. So 50,000 less 40,000. Again, operating profit here is 30,000. 50,000 less 10,000, sorry, it is 40,000, right? This is 10,000. So your gross profit you earned is 40,000. So what is your operating profit margin here? 40,000 is what percentage of 1 lakh? Definitely, I took the easier figure so that you can correlate. You got 40%. What you received was 100%, and then you started deducting your cost, so that you're analyzing three kinds of profit here. What you earned after deducting production cost only. Here, what you earned after deducting production and as well as non-production cost. So it was 40%. What you got was 100%, and then ultimately what you get as an operating profit is only 40%. So 100 minus 40, the remainder is basically 60% is your cost. And what correspond to this value? 50% is the production cost, and as you can see that non-production cost is basically 10% of sales. So 10% was the non-production cost. So you see that 50% and 60% correspond to this value, that I received a revenue of 1 lakh, but I only got 40,000 in the end because 60,000 was my cost, 50,000 was my production cost, and 10,000 was my non-production cost. So that's how I get my profit before interest and tax, which is operating profit. However, if I want to calculate my net profit, what I get in the end, and I would deduct interest and tax as well. Definitely, I may have taken loans, okay, and just to carry on my operations, just to purchase material, or might have some bank overdraft over which my interest is due. You know, I told you about capital. The two way we can inject capital into the business. One, we can have the shareholder funds. The other way, we can have bank loans, right? So there is basically some cost of investment, some cost of capital. For equity, what we give to shareholder? Dividends. We give dividends to shareholders, and for debt, we pay interest. We pay back the capital amount as well as the interest amount, which is basically deducted from the income statement. It is also an expense. Okay, and definitely you will pay tax to the taxpayers as well. So for example, 5,000 was your interest and tax. So what is your net profit in the end? So net profit in the end is basically 35,000. And we talked about that 35,000 makes what percent of the sale? Definitely that makes 35%, because 5% more was deducted. So what I got was 100%, but what I was left with, and I actually can verify my figures from here as well. So I added 100%, but what I get in the end is only 35%. So 65% is my cost, and 60% we have already calculated, which that correspond to 50% of the production cost and 10% of the non-production cost. And you see that 5% here is because of the payments of interest and tax. So what we are left with, net profit of 35,000 divided by 1 lakh. What does it make? I can do it in front of the calculator for you as well. That actually makes 35%. So 35% was my overall profit after deduction of all the operating cost That's your operating cost, like operating expenses, right? Production cost and the non-production cost. And also, so you get profit before interest and tax. And then after deduction of interest and tax figure, what you get is your net profit. Okay. So net profit 35,000 is what percentage of 1 lakh? And you can see that here. See that? Yeah. That makes 35%. And 50,000 is what percentage of 1 lakh? That is basically 50%, and so on, like operating profit. So then they will be having certain target. I told you the gross profit target was 30%. Now tell me whether that profit center manager who was responsible for cost as well as the revenue, and therefore we accounted the controllable revenue, what the revenue he actually generated. Okay, and this revenue wasn't generated by the head office, right? We talked about the head office concept. Head office cost wouldn't be something you would control, right? Head office cost has its own cost. So only cost and revenues traceable to its division only would be charged here when we would be assessing the performance of the manager, that how he is performing. Otherwise, if you're going to deduct the cost he couldn't control, he couldn't influence, definitely, and when its performance is getting impacted as well. After charging that uncontrollable cost, his profit is getting less, and definitely he is not able to meet his target as a result of charging that uncontrollable cost, and he's not getting his bonus. So since his performance is getting distorted, so definitely he won't be happy. He won't be happy for that. Okay. Here, for example, the gross profit target he was given was 30%, right? And he performed exceptionally well. His performance, he actually, and he definitely, he earned 50%. So 30% was the target. 30% target meant that he had the leverage of spending 70%, incurring 70% of the production cost. Yeah, as per the target. Yeah, but that actually proved instead of spending 70,000, he actually spent 50,000. He controlled the cost. How you can increase the profit? Either by decreasing cost or by increasing revenue. Yeah. So he'll be having cost target as well as the revenue targets, and his performance would ultimately be based upon what profit he's generating for his own center. And then it will be decided whether you would get a bonus or not. So here, for operating profit, for example, 35% was the target. Yeah, 100 minus 35 means, sorry, 100 minus 35, 35 was the operating profit, right? So he was allowed to spend 65% of the total cost, production and non-production. However, he only spent 60,000 of the cost, means that makes 60%. So he already saved 5% cost over there. So his performance is pretty good. As compared to the targets, he's performed exceptionally good. Your target was 35%. He actually controlled the cost. Yeah. Incurred cost less than the target. Definitely when the cost would be less, profit would go up. Yeah. So his net profit target was, for example, 20%, right? So what was he given? 100%. The profit, net profit should have been 20%, means 80% was given to the total cost, as well as any interest cost, as well as any tax payments. 80%. So here again, he saved some cost. Instead of spending 80%, he only spent 100 minus 35. Spent 65%. Yeah, that we already calculated. 60% was the production and non-production cost in total, and 5% was the interest and tax. So the profit he earned was 35%. He actually controlled the cost. So his performance is pretty good. His performance is pretty good. Now, do you guys have any problem? Can we move on to investment center? You can ask questions if you want to ask. Okay. So now the responsibility is increasing. Since cost center manager was only responsible for cost, revenue center was only responsible for revenue, then profit center manager was responsible for cost and revenues both. Now, what is an investment center? Investment center is a center that is ultimately responsible for everything. Means investment center is basically, by definition, investment center is a profit center, however with additional responsibility for investment and financing decisions. Investment and financing decisions. So profit center manager wasn't involved in any of the investment decisions. The only target he was given was to increase the profit, right? But the investment center manager performance would be judged upon how much profit he is earning in relationship to the amount of investment he is incurring, right? So here his performance was profit to sales, right? Profit as a percentage of sales, that what is coming, okay, as a sales and what he earned at in the end. So what he was responsible for profit and only for the cost and revenues. Means he was only accountable for the profit. His performance wasn't judged that what, for example, if he's earning 20,000 profit and he on an investment of 1 lakh, now his performance would be based upon what is the return on investment. What is the return on investment? So for example, in this case, what is the return he's earning over 1 lakh investment? So that's 20%. So that's how his target would be set. So that automatically makes him accountable not only for generation of profit, means not only for cost and revenues, but also for making worthwhile investment also becomes his responsibility. So definitely in business, the heads definitely take decisions. So this is would be the one, the most senior who's ultimately responsible for everything. And here his responsibility is also to make worthwhile investment and choose those investments that actually maximizes more return. Yeah, there's one investment that on 1 lakh is giving a return of 20,000. That means it's 20%. And then there's another opportunity he got that basically gives him the return of 50,000 over an investment of 1 lakh. So now tell me which investment he would choose. Definitely the one that would maximize the return on that investment. So for an investment center manager who is responsible for generating profit, but in relation to the investment amount of investment he's doing. Okay. So actually, if the amount of investment increases, the profit would decrease, since investment is inversely proportional to just a minute. So an investment center manager, how his performance would be assessed. So definitely he would be given some target, which is basically be based upon the return he is supposed to generate. So there are two performance measures for an investment center, how to assess the performance of a person who is ultimately responsible for everything. Okay, assessment, how to do the assessment of an investment center manager. So that would be done based upon his performance measures would be different. So there are two performance measures that actually assess the performance of an investment center manager who was responsible for cost, revenues, means he was responsible for profit, and he is also responsible to generate good profits over investment. Profit over investments. And I wrote he is also responsible for financing decisions. So definitely for investment, you need a finance, you need a capital. So he'll be, whether he's getting capital from the shareholders, he'll be managing everything. His end-to-end will be appraising the projects, different opportunities, and then he would be arranging finance as well. So he would be responsible for everything. Definitely he'll be having his own team who would be working, some treasurer who would be basically dealing with the banks and getting the opportunities, whether or just arranging investors or the equity. Okay, so Definitely, but he would be making the financing. Additionally, he would be involved in the financing decisions as well. So for investment, you need finance, and how finance can be injected, how capital can be injected. I told you it's two ways, like from shareholders or by bank loans. Okay. So definitely he would account for that as well. So and how his performance would be assessed based upon two factors: return on capital employed, which is basically return on investment, also called return on investment. So return is basically profit. Return on capital employed. Now we will see what is capital employed. Basically, capital employed is your investment as well, and return is your profit. So I told you, generally the formula is profit over investment, right? But there are tons of ways you can actually assess the return over investment. We are going to look at, and with perspective of F2 and PM as well, we're going to look at MA1, MA2 level, that what should be the formula you need to calculate the return on capital employed. And the other one is the residual income. So the two measures, just like gross profit margin was one measure, performance measure, which will basically measure the performance of the manager and then will give you an idea whether he has achieved his target or not. So just like that, in a profit center manager, the performance measures are gross profit margin, net profit margin, and operating profit margin. So just like here, the two performance measures to measure the performance of an investment center. One is return on capital employed and the other one is residual income. So what is return on capital employed? Return on capital employed is profit before interest and tax, which is basically your operating profit, right? Operating profit divided by capital employed. Okay, one ways to measure the capital is basically capital employed is basically your capital equity plus long-term loans. If you know the balancing equation, asset is equal to capital plus liability. There are two ways you can inject the capital into the business. One equity, and other one you can have the liabilities like long-term loans or even short-term liabilities, right? Current liabilities. And asset is basically could be current assets as well as non-current assets. And capital, okay, that's equity. And there are also two kind of liabilities. One, you should pay within 1 year. One, you can pay after 1 year. And current asset is basically which you should be aimed to selling within 1 year. Okay, and you cannot keep it. That could be your inventory. Like you produce and make shirts. You should be selling whatever is going to be your current assets, your inventory, for example. You should be recovering money from your current assets within the time span of 1 year. You cannot keep it longer. But non-current asset is basically, for example, you have had a computer or you had a building, definitely, or any machine installed in the factory. So definitely that is your non-current asset because that is going to give you the economic benefit for more than one accounting period. And that's not your current assets, right? Not your inventory and all that. So it could be land, building. So that's the non-current asset concept. So asset could be current asset, non-current asset. Liabilities could be current liabilities, for example, overdraft, like payables, you need to pay your suppliers definitely within 1 year. And definitely you need to pay back the bank overdraft facility. What is bank overdraft? You don't have money and you ask low kind of short-term financing from the bank. That's called the bank overdraft. Then yet again, that's your liability and you need to pay off that liability within 1 year. So it's going to be a current liability. And also the non-current liabilities. So liabilities are also of two types: current liabilities and the non-current liabilities. Could be your bank loans. You took a loan for 30 years, 10 years, yeah, 5 years, or any value above 1 year would be considered in your long-term loans, non-current liabilities or long-term loans. Okay, so if I bring the current liability over here, okay, from current asset plus non-current, okay, if I non-current assets plus current assets, if I bring current liability over here, okay, what does it become? The two ways capital employed, the two formulas basically capital employed can be calculated from. The formula number one is, so you see, if I bring current liabilities over this side, what I'm left over here on the right side is capital plus non-current liabilities. Capital plus non-current liabilities. So the number one formula for capital employed is capital plus non-current liability. Long-term loans. Equity plus long-term loans, or capital plus non-current. That's number one formula for capital employed. There's another formula for capital employed as well. If you see here, what is this? That is basically your net assets. Okay, that is basically your total assets less current liabilities is basically the net assets. That's the net assets, right? That's the net current assets. Current asset less current liability is basically the net current assets, right? If you knock off your asset and liability, what you get is net current assets, right? And in net current assets, when you add your non-current assets as well, that actually becomes your net assets. That actually becomes your net assets. So net assets is equal to capital plus non-current liabilities. So number one formula of capital employed could be capital plus non-current liabilities, and the other formula for capital employed could be net assets. Net assets. So why I'm mentioning these formulas, and net assets would be total assets less current liabilities. So that's how from the balancing equation I've made two type of investments. Basically both sides of is equal. So it's nothing, I've just brought the current liability over here, and so net assets is equal to capital plus non-current liability, right? So one formula, capital plus non-current liability, is also your capital employed. This is also your capital employed, and net assets could also be your capital employed, right? So in whatever manner you need to calculate return on capital employed or return on investment, which is going to be profit over investment, and two formulas by which I can actually calculate my investment, right? Formula number one, this, and formula number two is this, okay? And which profit I need to take, that's very important. That needs to be profit before interest and tax. If interest and tax has been deducted and you are given a profit after tax and interest, if it is deducted, you need to add interest and tax back. You need to add back. Why? Because you need to take the operating profit only from which the production cost and non-production cost is deducted, which is basically only operating expenses are deducted and nothing else is deducted from them. So that's one formula, that how you're going to assess the manager performance by linking the profit is generating over investment. Okay, like for example, the profit before interest and tax was 20,000, and the capital employed is, for example, 1 lakh. So what is return on capital employed is 20% in this example here, right? So let me take another example. That how these two formulas can be used in order to calculate the return on capital employed. Okay, it would depend upon if you're given your capital and non-current liabilities, but you're not given information about your current assets, current liabilities, and your current assets, current liabilities, and non-current assets. Okay, so if you're not given information about, you're only given information about capital and non-current assets, so you're not given information about total assets and current liabilities. So definitely you're going, in that case, you're going to use the formula of capital employed. Okay, have a look at this question. Here, I am given my land is 1 lakh, okay, and my buildings is 2 lakh, okay, land and building, okay, and bank loans. I'm also given my bank loans of, for example, 2 lakh, yeah, and I'm also given profit after tax and interest, and profit after interest and tax is basically, for example, if it is 50,000, okay, and I'm also provided the interest and tax amount, right? And that was 10,000. And now you need to calculate your return on capital employed, also known as ROCE. And it's the same as return on investment. And return is basically your profit. Return on sales is different. Sales cost is not deducted, but profit cost is deducted from that. So return is not your sales, right? Return is basically after deduction of cost, what is basically the residual profit you have earned. So we need to link profit to investment because his responsibility was cost, revenue means profit, and what profit he would earn in relation to the investment, right? What profit he would earn in relation to the investment. Now, can you help me calculate what is the ROS in this case, guys? What I need is, number one, what I need is profit before interest and tax. But what I'm given is profit after tax and interest of 50,000. How to get a value of profit before interest and tax? What I can do? Can I add back 10,000? This is how I will get the profit before interest and tax figure. Like the situation was like this. It was PBIT, right? And after that you deduct what? Interest and tax. And what was the amount of interest and tax? Was 10,000? Yeah. And what you get? A figure of profit after tax and interest, also known as PAT. And the figure was, this figure was 50,000. You are given this figure and you want to calculate which figure? You want to calculate this figure here. What I need to do? What I need to do? In 50,000, if I add back 10,000, I would be able to get profit before interest and tax. That's what I want. That's what I want in the numerator. I want is profit before interest and tax, and that is 60,000. Now, what else I want is capital employed. Which formula? Now you need to know how your data is, whether, okay, this is capital. Okay, sorry, the data, I need to mend my data here. Okay, land I'm given 1 lakh, buildings is 2 lakh, okay, and then I'm also given my inventory. Inventory is, for example, 10,000, and I'm also given my payables of 20,000, and I'm also given my bank overdraft of, for example, 50,000, right? So now here you need to calculate return on capital employed. So by which formula you're going to calculate your, either by number 1 formula or number 2? Tell me. You have land and building, so that's your non-current assets. You have inventory, that's your current assets. And then you have payables and overdraft. These are your current liabilities. So which formula you're going to use? I'm going to use the formula of net assets here. What are my total assets? If I calculate my total assets is basically current asset plus non-current assets, right? And non-current asset is 2 lakh plus 1 lakh, 3 lakhs, right? And my current asset is 10,000. So 3 lakh 10,000 is my total assets. Now my liability payable, I need to pay my suppliers. I need to pay the bank for the overdraft facility, the interest on. So definitely 50,000 plus 20,000, both are my current liabilities I need to pay within 1 year. 50,000 plus 20,000, that's 70,000. Now tell me, what are my net assets, and also calculate what is my return on investment. What is my return on capital employed? So 10,000. So it was 10,000 plus 3 lakh of non-current assets, right? That makes 310,000. And then it was 50,000 payables, or 20,000 of payables, and 50,000 was the bank overdraft, right? So that makes 50, 60, 70,000 minus 70,000. So it was 2,40,000. How good is this investment? This investment of 2,40,000 is earning a return of 60,000. 60,000 is what percentage of 2,50,000? 2,50,000. That makes 25%. It's a reasonable investment. Okay, it's a reasonable return from that investment. And I'm going to measure I want to assess the performance, and this is one of the performance measure, return on capital employed. Now I will see what was the target return on investment. So target return on investment was, for example, 20%. So that means he has performed, it's pretty good. His performance is